Hi, everyone. Welcome to Analyze Your Trade, episode number 41 for January 10th, 2018. We are broadcasting live on YouTube, but at 4:30 p.m. Eastern Time. But I'm also releasing all episodes of the show now as audio-only podcasts that you can find on Spotify, iTunes, Stitcher, or wherever else you listen to podcasts. Today we will be discussing your trade ideas. And over the last few days, about 50 people have submitted up to 5 symbols each. And I've put together the list, which you should be seeing on your screen right now. And we're going to get through as many of those as we can. My name is David Kosmeter. I'm the creator of TimingResearch.com. And I developed this show with Dean Jenkins of Follow Me Trades. And he is here to moderate today. So I'm going to go ahead and turn it over to him.
All right, thanks, David. It's good to be here again, and we got a good panel, and looking forward to walking through these trades and hearing everybody's opinion. You know, if people are watching, you can see David's profile picture. We were joking beforehand; it looks like some kid we saw at a AC/DC concert. But now that I look at it, he actually looks kind of like Malcolm Young. So, approach to the markets is, and we'll start with you, Christian.
Yeah, thanks, and always a pleasure to be on the panel. Looking forward to going through some charts and some good names on the list, so looking forward to it. Yeah, sure, just quick 10 seconds about my background. My name is Christian Fromhertz, and I run the Tribeca Trade Group, where we do a couple different things there. I run an all-day trading room, and we read the tape all day long. We look at option flow. We look at big ETF blocks. There's a couple big ones today. And I basically do a lot of swing trading, probably about 80% swing trading, 20% day trading, and provide signals, you know, a little bit based on some of the option flow that we're seeing, but a lot of technical setups, a lot of trend following as well that we do at Tribeca Trade Group. So again, happy to be on. Thanks for having me.
All right, good to be here with you. And
I am Jim Kenney, and I do produce the content for OptionProfessor.com, which is basically an education firm on the uses and the risks of all the different option strategies. We try to encourage people to learn all about the options so they can use the options for a variety of purposes, be it limited risk speculation, or be it for cash flow purposes, or also for hedging positions. It could be a very effective tool if done properly, and we try to help you learn enough so you could use them properly.
All right, and good to be here with you again. And Larry, tell people who you are, what you got going.
Yeah, thanks for having me here again. It's always fun. I always like to look at all the different stocks. And yeah, so Larry Gaines, I've got a site called Power Cycle Trading. It's a educational trading site where we focus on directional trading using our trading model, and then using options to trade those particular directional trade setups, you know, for really good leverage and define risk. Like to look at trades from a, kind of a shorter duration swing trade approach, anywhere from 3 to 10 days, something like that. And been actively trading for over 30 years, ran a really large international trading desk for 10 years where we traded pretty much all the commodities. So a lot of background in trading in general. So really enjoy it. And I like to teach and pass on what I've learned. So thanks again for having me.
Yeah, good to be here with you again. And I am Dean Jenkins, founder of FollowMeTrades.com. I'm a trader, been trading for over 25 years, and I focus primarily on stocks and options. I use a combination of Elliott Wave, Ichimoku Cloud. I call it East meets West. When they agree, it's pretty powerful. Probably a longer hold time than Christian and Larry. I'm typically in trades 4 to 6 weeks, but it is a form of swing trading, just looking for the next impulsive move and then grab it and let it run. I offer a stock advisory service. I just publish the picks right before I take them. And same thing I'm doing in my own account with my own money. And I have a live trading room at the open for an hour and a half each morning where we review the overall market, look for new trades. And I really enjoy teaching and just interacting with traders on a regular basis. Trading's fun, best job in the world, right? All right, let's jump into the list. We've got some of the usual suspects, a couple new ones here. And we're going to kick it off with Biogen, BIIB. And we'll just keep that same order that we introduced ourselves with. So Christian, if you would offer your thoughts on Biogen.
Yeah, absolutely. And well, this is an interesting one. Obviously a big gap up after drug announcement that they had, but it looks like they ran right into a little bit of resistance and are doing a little bit of digesting. That looks like, you can see on my charts 370.57. That is resistance, and it looks like we, pretty much tagged that perfectly. So, it could be, and I'm going to go out on a limb here a little bit, but I'm going to say that it probably is going to digest a little bit. It's got earnings right in front of it. If it holds up here, I would say okay, but it's got to take out that resistance. So, it's a pretty decent move that you've had. I don't have any Biogen. I think there's a couple other biotech names on the list, which I can't wait to get to. But certainly this was a big catalyst. So I don't own any Biogen. If I held it through this gap up and I was holding it before, I would be taking taking some targets personally, taking a good amount off, and then waiting to see how it kind of processes through earnings, and maybe it ends up doing some type of a bull flag here for a bit. But I would say for support, watch that 5-period moving average. Let me just see. I don't think I saw anything on the weekly chart. Nope. You're basically just, I think using the short-term moving averages as a guide, maybe use that 5-period moving average, which I've got drawn on my chart. As long as it holds that, you could maybe hold your last piece of a winner, and then see if it can take out that prior resistance. Where did that go on my chart? Looks like I lost it, but I think you know what I'm getting at. Yeah, there it is. So yeah, I think you want to watch that ultimate 370.57 resistance, but for now, digestion mode.
That's a new term for me, digestion. I heard you say that earlier, and I was going to ask you about it. What do you mean by it? It's digesting?
Yeah, I mean, just after a big move, such as this big gap it had, it's kind of like back and filling a little bit, basically just processing that move. And I think as long as it hangs above, give it that yellow line that I've got, which is the 5-period fast move, it's a fast moving average. As long as it's holding that, I call it digestion mode, and if it breaks it, then it's clearly not doing digesting anymore. It's breaking down a little bit, but it could just be, holding those gains from that big gap up.
So below the 5, it's moved farther down the alimentary canal, lower regions.
You got it.
All right. Hey, Jim, what do you think of Biogen?
Well, this sector is definitely getting a lot of money coming into it, so that was a good thing for the stock. And obviously, it had the good news on the drug. Now, that's all good stuff. The stuff that's not so good is the moving averages are in the 290, 300 area. We hit about 370, so they're like 25%, 30% above their moving averages when it hit the 370 mark. So it's not a shock that it would back off a little bit. And the volume today was no joke, 3.3 million shares almost, and it averages out at about 1.8, 1.6 million generally. So the volume was pretty much twice normal, and it did get hit pretty hard. And I think I'm not the only one who could see that it was pretty overbought basis the moving averages, despite the news. And that's why, if I was personally involved in the stock on that rally, even now I'd start pricing out what calls above the 370 mark would be and see if I want to collar it to try to protect my equity or bring in cash flow while the premiums are rather high. Because with this volatility, probably the premiums, well, I know certainly when they were in the 370 area, the premiums must have been enormous. And that's what you got to do. You got to look for the right strategy at the right time. And when premiums are explosively high and you think the market is very overbought or testing a former high like this one was, you have to talk about probabilities and odds, and huge off-the-chart premiums on a market that's overbought hitting resistance is not a terrible time to look at the calls.
Selling the calls, I would assume, Jim, right?
Yeah, look at them and sell them.
Just want to be clear.
I don't know what I don't have the premiums in front of me, but if the 400 calls going for 30 or 40 bucks and you're at 370 and you're not a believer that it's just going to keep going ad infinitum, that's a heck of a nice premium. And if you took in 30 or 40 points while this stock has lost 30 points, at least you'd have some kind of a buffer on your equity from the drop that you're seeing from the highs.
All right. And Larry, what you got on Biogen here?
Yes. Well, it's already had such a huge run. It's kind of, if you're not in it, to me, it's not one I want to really play in. So again, talking about digesting or consolidating, you've got this huge gap up you can see here, and it's trying to consolidate. So it's been a strong move, so it probably will. But you do have earnings in about 2 weeks on the 24th, so it's going to probably just churn and stay in this kind of range. So in front of that, I mean, it's probably going to just have some time decay to it and just kind of stall here. So there's not a whole lot I'd be doing here until after earnings, and then see if it takes out this prior high. But it's already had such a big move. To me, when you see a stock that moves like this, I just usually look for something else, because the big play has already been made. So I mean, we're going to go through so many other stocks, so there are just so many things. So if you're already in this, I would definitely have some profits in it, and I would definitely hedge take some of the risk off by selling some out of the money calls against it, or call spreads, to convert this into what we call a long call condor or something like that.
Yeah, so both Christian and Larry, made the point, hey, if you were there and, caught that gap up, take some profit. Boy, I would sure echo that. When there's a huge gap like this, I stand aside for a while and let it see what's going on. They can go fill these gaps. It would, and that's a hard thing to judge. You notice it gapped up to almost to a prior high, pretty significant resistance level there. So upside potential in the short term, of course, everybody's mentioned you got earnings coming up, but over the next couple of weeks, getting above that prior high, I think the probability is pretty low on that. It's not the kind of chart I look to trade. If I had been in it, there was an entry signal prior to the gap as it broke the 200, broke the Ichimoku cloud. We had nice positive momentum. So there was an entry to catch that gap, but it's over, right? I just don't think there's any trade here using my criteria at the moment, but it's a fun chart to look at and talk about. Next up is SPY, the S&P 500. And we could spend the rest of the session talking about the SPY probably, but why don't we just offer a couple quick thoughts so we get through the list. Christian, where are you at on the big daddy, the overall market?
Yeah, sure. And I'm just going to bring up a chart of S&P futures because, it's going to look exactly the same, but I've got some trend lines drawn in here and so forth. I got a lot of lines going on here, which is pretty busy. So maybe I will use the SPY. Interesting. There was this huge trade that went up today, and in SPY, it was an over 3 million share block. And I think I have it up here, but I think it looked to be a sale, but it's kind of funny because at the same exact time, it looks like somebody swapped out of shares, which is my guess, but somebody sold 3.1 million shares of SPY today, which is no small feat. $863 million of SPY they sold today, but I think they swapped out of this and into a Schwab ETF. So it's funny because people are so focused on cost. A very similar looking ETF, and they went into SCHX. So 129 million shares of it, 12 million shares of this ETF. So somebody swapped out of SPY. So anyway, I thought that was pretty interesting to see that type of trade, but just kind of gives you a sense of sometimes what institutions are doing. Sometimes they're just, hey, I want to stay in the market, but I'm looking for something a little bit cheaper. But anyway, back to the SPY chart. What I had on the S&P futures chart was, we're basically back to the scene of the crime. We've had some issues with this area now. This, call it the 280 level to be, it's a little bit shy of that, but I think you know what I'm getting at. Right around 280 seems to be a lot of overhead supply, and we failed there. Since we made a 52-week high back in January, we've run into this situation now a couple times. What looks a little bit different to me? Well, we're on the top of value, which is also coincides with that 280 level. I use value areas, which is value at price. Which is volume at price, which really gives you some nice support and resistance levels. So we're at top of value. We're kind of at an indecision area. You know, I think there was a pickup in the VIX today a little bit. You know, maybe some, you know, a little bit more index hedging today as we kind of reach the top of this range. But I do like, so that's kind of, you know, people I think hedging themselves a little bit. So that's a little bit of the negative. A little bit of the positive is we have a nice MACD crossover here. So maybe it's 1, 2, 3, 4 times the charm. We'll see if we can break out here. But certainly, I think to kind of keep an eye on this area the next couple of days. I think this 280 area has been a very important area throughout the year.
Yeah, that's like a hard ceiling right now, isn't it? The 280 level.
Yeah, and I like the way that you've got your line drawn there. That's perfect. It's a big decision coming up. Yeah,
definitely. But depending on how it behaves around that line, it may be tradable. But Jim, let you get your comments in on it too before I go off too far.
This is the big question that everyone's facing right now: is are we breaking out, or are we just retesting the top of the range? And obviously, it's a very big question that has to be answered. I think it's going to come down to how big the GDP numbers that come out, and the earnings number, and the guidance that comes out. Because if it comes out, very, very bullish, then obviously we can go through these numbers. The VIX went down towards 12, and I've been a believer that 15 area is the equilibrium. So when you get up to 20, it's going to come back to 15. So when it goes up to 20, obviously you want to get long the market. And then when it goes down towards 11, 12, whatever, if it's going to go back to 15, then you'd want to be short the market. So right down here, I think we have to keep a good eye on it and see if it is going to roll over a bit. A couple of things that might give you a clue that it might be rolling over would be a break under this today's low, 27.86. Corresponding moving higher than 1321, which is today's high on the VIX. So today's high on the VIX and today's low on the S&P might be worthwhile number to keep a look at. Also, there is a gap, looks like around 2760, so wouldn't be against the law to go down and fill that up a little bit if people start backing off the bullish stuff that they're on right now. Obviously there could also be quite a bit of short covering that went on as well, because we did take out last month's high. 2791 was last month's high, and today we took that out. So if you're one of those people who put the stops above the former weekly or monthly highs, you're pretty much out. And so the key is going to be, is there any volume behind us now to keep the thing going? Google did a little bit of a rollover. Transports didn't look that great today. And the Russell, these are the leaders, right? And, they both look a little bit like they were softening today. So, again, we start taking out today's low above 1321 on the VIX, and we may come off of this number.
Okay. And Mr. Gaines, S&P 500, SPY.
Yeah, so basically in line with what the other guys are saying, I mean, you can see here, this is a big ceiling to the market. We've been up here. This is a weekly chart. So you see we've been up there in, January, March failed, again in June failed. So the more times that you have something, chipping away at a major support or resistance level, it will finally break. So this could be the time, but I think right now the initial thrust to the upside, you want to be patient, wait it out. And wait for some kind of catalyst to break. And then the way that I like to play support resistance is let it break and then retrace back into it. If it holds, then you jump into it. And then we'll get a push back towards those prior highs. But right now, with this big move we've had over the last several days since last week when we had the non-farm payroll number, we've hit this objective. So I think the market could start kind of churning a little bit, maybe pulling back a bit, and then see if it holds the some Fibonacci support levels or moving averages and consolidates, and then gives itself another shot to the upside. And we never know what that catalyst will be. We do have earnings coming up, so that could be the catalyst, or it could be something that comes out, from other news, GDP or Trump or trade war, whatever. So, but right now you can see it's into this resistance. I would let it just kind of back and fill a little bit.
All right. So everybody's noted this, on the SPY, it's 280 level, went up and tested that, found resistance coming up on the third time. So I'm watching that level really, really, really closely. If we reverse off it again, there may be a short-term swing short opportunity. And if we break through it with real momentum, not just a tick or two, but get a solid close above that, probably looking at new highs, which is surprising. I'm every day that the market goes up, I'm shaking my head. If you remember this big drop back in January, February, that whole deal was just the threat of tariffs and a trade war, and they just went into effect, and now we're going up. Like, what's up, Alice? So you have to kind of tune out what should be happening to just watch the reality, what is happening, and that 280 level on the SPY is really critical. If we smash through it, we're probably on a record high, all-time highs. Reverse off it, probably a short-term shorting opportunity. But we got to wait. Nothing there at the absolute moment for me. And now we're going to look at XLF, sector fund. I believe that's financials. I'm not, financial sector from SPDR. I got all kinds of thoughts on this, but let's go in order. Christian, the financial ETF here.
Yeah, sure. And this is definitely an interesting one, right? I think it's one of the questions that a lot of investors have is, what are these banks doing? Why aren't they rallying? They had good, the stress tests were good. They're announcing a whole bunch of buyback plans, which I don't think go into effect for a little bit. Those big buyback plans, which I think will be a catalyst for them. So I will give you my overall. I will always have an opinion on the banks. I used to work at a couple of them for a long time, so I certainly have kind of an inside feel for the banks. Which I'm saying banks, but obviously this is the financials ETF. So let's just talk about the technicals really quick. It's still underneath the 200-day moving average. There is some support here. My view on the banks is to of all the sectors out there, I'm underweight the banks. Coming from a bank, I think the profit that these guys are making, it's just different. I don't know very many people, besides myself, or if you know anybody who works at a bank who works at an investment bank on a trading desk, ask them how they think their business is going. And you don't hear a lot of great things. You usually hear, it's okay. We'll see how this year goes. You just don't have, when the banks and the financials were doing extremely well, before the crisis back in 2008, 2009, things were doing a lot better then. The morale was a lot better, and I don't think we're ever going to return back to them unless something really changes. So I think when these things get cheap, when there's a level of support to trade off of them, I think JP Morgan, Wells Fargo, a couple of individual names there look attractive at this point going into earnings. But I think that the financials ETF, I think maybe it's worth a shot if it gets above the 200-day moving average. But until then, I would probably have a lighter than normal position in XLF and maybe an avoid until the price actually does something and gets above this range. Another question that everybody always has is that I always hear is, oh, well, we need the financials to participate for the market to go higher. I completely disagree with that. I think there's plenty of areas that are doing very well. I view the banks right now as more of a utility. So if you think that the utilities need to go up for the overall market to go up, then you may, that's one point. But I just don't think, and the financials are a bigger weight in the S&P, but they're not a 20% weight like tech. So right now, I view them as an avoid, or maybe take a small position in. I think Wells Fargo is above the 200-day moving average. That one looks interesting to me. JP Morgan is getting there. Citigroup announced this huge buyback plan, but I don't want to really mess with it until you almost have a curving over 200-day moving average, which I don't like that. So sorry to go a little bit over there, but it's an interesting topic.
Yeah, it totally is, and you gave some real good insight, and your background is really helpful, Christian. Do you trade short, or are you long only, Christian?
I do trade short. I just haven't been doing it much. You know, I think in the face, and the reason why for the banks, I haven't gone that way is because, you know, they are below the 200-day moving average. But I think once these buyback plans kick in, I don't really want to be running in the face of, you know, an algo machine that's going to be buying shares every day. So I kind of just, that's why I'm kind of neutral.
Yeah, that's a good comment. One of the things I've started adding to, you know, because I do like to go short, but I've refined my strategy a bit. And you want to be aware of, you know, they can only buy back during certain windows, and then as they approach earnings and stuff, there's a window where they cannot do buybacks, and you just want to be aware of that. Where if you're trying to short something and they're propping it up with internal buybacks, you want to be aware of that, those dates. I think that's important. But Jim, XLF.
Yeah, well, yeah, this was probably one of the most popular sectors to be in January of this year. I think everybody and their brother was saying, you got to be in the banks, you got to be in the banks, financials. When interest rates go up, these guys are going to make a ton of money, and you just got to get in there. And that could have been one of the worst bits of advice you could have picked up here this year, because some stocks have rolled over pretty well, like Goldman Sachs, you know, from the 275 area down to 220. So you get whacked pretty hard here if you went in heavy on the financials in January. There's no doubt about that. Why do you think they haven't gone up? I think one of the reasons is loan demand stinks, and I think people's appetite for debt is way different now, either because of their age or their financial circumstances, and they are a little bit more paranoid about taking a bunch of loans out. So I think that might be one of the problems that it's having right now. And also they're going to have to start paying depositors, and you know, that might pinch their margin, because they're not going to get away with no money in the money market anymore when everybody's paying interest. So the payouts that they are going to have to make, and the loan demand that had not materialized, probably the two things that are probably bothering it the most. And as far as being real positive on it, you know, it's still possible that they have another big leg to the upside. But as you guys were saying, you might want to play the Missouri deal, meaning the show me state, before you just start jumping in here. And the next thing you know, because some people are actually saying there's a big head and shoulder top in Citigroup, and they're looking for a substantial drop. So certainly it's a two-way conversation now, where it was one-way conversation in January. And maybe for that reason alone, you know, it's a good thing to monitor for an up move, but maybe not jump in right this second.
Okay, and Larry, XLF, financial sector.
Yeah, I don't see a whole lot of excitement here. You've got really good, pretty decent support going into the monthly expiration next Friday, not this Friday, but next week at $27 here. So fairly decent support there. So that's a 382 retracement to the downside. So I kind of see it holding right in here. And then you've got this big kind of resistance area up above, 618 retracement, and you've got that 200-day moving average. So it's kind of stuck inside of here. We've got the banks, a lot of the earnings on Friday, but I don't see a whole lot of, I think, again, they're better places, I think, that are going to have more potential momentum. You've got a flattening yield curve, and that's not great for the banks, because they like to borrow, you know, borrow short term, lend out longer term, and lock in a margin, so the margins are squeezed. So that's going to hurt them down the road. So I think, and so it's not a really sexy area. I think there's some other better places to look for some good momentum type trades.
All right. You know, my analysis here, you know, a few of the folks noted it's XLF is below the 200, and what's new here is, you know, it's put in pretty good low, lower high, new low. It's under the cloud. It's under the 200-day moving average, and it looks like, so I would definitely not go long under the 200, under the Ichimoku cloud here, right? That's like a, you know, plate steel on the top of this for now. If you get a good reversal and it breaks this prior support level, if it goes below, you know, call it 26, 27, good solid close, you're probably going to continue this downtrend in this correction down to a midpoint of about 23. That could be a decent short. but not until it takes out that support level. So I'd be watching that. No trade now. It's in a neutral zone. Definitely not go high, not go long below the 200, and look for a short below 26, 27 would be my take on that. And now I think I heard one of the other guys was chomping at the bit to get to some of the other biotechs, and now we're on to Celgene. And that is an interesting chart. So Christian, CLEG.
Yeah, I think this is really interesting, and I'm interested to hear what you say on this one, because I know that you are a trend trader, and we're sitting here way below the 200-day moving average, and you have the Ichimoku cloud up, which I don't use that much, but I'm familiar with it, and it looks like it's getting over the cloud. So I can't wait to hear what you are going to say about this one. I'll give you my quick 2 cents on this. So weekly chart, it's been in a massive, big move down here on the weekly chart. But it's starting to get above this channel. So the good news. So if you're looking for a counter trend trade, and I don't trade very many trades below the 200-day moving average, but if you switch over to the daily chart, you've got, my feeling on counter trend trades is, first of all, I usually take lesser size than I normally would do. And then secondly, I would look at a pretty good frame of reference if you're going to trade something below the 200-day moving average. And one of the things that I like is it has been basing here for a little bit. It's not the longest base in the world, but you could see it has been basing, and it's now above the 50-day moving average. So if you want to give this sucker a go, I think as long as, and we've been talking about this a lot in our trading room, and the trigger for me was the 50-day moving average, because once you get above the 50-day moving average, you could say, okay, if it starts to fade and go back the other way, that's the point of exit where the trade will go wrong. But for now, I think, maybe this can get up to $90. So, the other thing that's nice about this is it's got a long way to get to the 200-day moving average. So it could do quite a bit of retracement. So, it can't be one of these trades where like, oh, I'll wait till it gets above the 200-day moving average, which is all the way up at 98. You're going to miss, what, 15%? So I think as long as you're using a frame of reference with the 50-day moving average, I like it here.
Okay. Well, you may have just about given my full analysis already, Christian, but I'll add a few comments when it's my turn. Jim.
Yeah, well, this thing in Q4 last year had the big gap down, and so there's a kind of a big gap between ballpark 140, 125, and then 120, 110. This sector, again, has been getting money coming into it here, so it's probably benefiting a little bit from that. And, I like to look at overbought conditions basis the 200-day. So when we were down at 75 for a while back in May, and you were at 100 or something like that on the 200-day, you get 25, 30% under or above the 200-day. There is some probability that it may go the other way. You can always use maybe a previous weekly low. So in other words, when it was making its lows around 75, it made some kind of a weekly low. The next week, if you think it might be turning because it's so oversold, you might consider using that weekly low as your get out point and see if you can catch a bounce, which is basically what's been going on. So there's still room for it to bounce, and the sector has got money coming into it, but it's definitely something that is just right now without news. You're just looking to see if it might close the oversold gap that it's been having. For it to go up into those gaps of 140, 125, 120, 110, you're going to have these people come out with some kind of news like Biogen did.
Yeah, and that's always the deal with a drug company. There can be big news that can cause gaps either direction, and you don't really have any warning on that. All right.
Well, one quick example of that is Biogen, because the 50-day and the 200-day are still inverted to the downside, but the stock went all the way up to 370. So that's a poster child of how these stocks, can come out of the blue and do totally something different than what it's been doing.
Yeah, absolutely. Larry, Celgene.
Yeah, with Celgene, all the drug stocks last week had a really nice, what we call kind of a volatility compression. You can see everything. This is a weekly, so everything was basing down to the downside and then started turning, and we had a pretty good break to the upside. So now we're coming in some resistance. This is a 21 period moving average, exponential on the weekly. So that's going to be resistance right there at that prior high. So 86, and I could see it potentially getting to 90, which would be a retracement level from a Fibonacci standpoint. So, you know, I still think it has more potential for the upside, but the big sweep move has been made. You can see when it broke last week, that was the sweet spot of it, and it got back over that 618. So, you know, if it comes back and holds this area, I think it still could push a little bit higher. But you know, this is definitely when you get extended like this, if you've been in the trade, this is where you want to be taking some profits and then converting it, maybe taking a little risk off by hedging it, by selling some out of the money calls against it or bear call credit spreads. So still potentially could push higher, but you know, you got to pick your spots, and I'd wait for more of a consolidation. Also, you've got earnings coming up, I believe the 23rd, so could get a little bit more possible run into earnings.
Yeah, it's a aggressive trade to try and trade this, and you know, the analysis I have I think Christian mentioned it. It had based, you know, for 6 weeks, 8 weeks. It was basing pretty nicely. It broke out of that, and the new thing, you know, when I'm using Ichimoku Cloud, one of the things I like to look at is how well has the chart respected the cloud, because some charts don't, right? They blow through it both directions. But since the gap, you know, since last fall, it has respected the cloud, and you know, the move up hit resistance and then reversed, and you know, pretty consistently. And then when it breaks the cloud like it just did, that's new information. That's something new going on with the stock. And so I use an acronym. I like it. It's WIO, WIIO. What if it only, right? And so with Celgene, what if it only went up to the 200? Well, that'd be a good trade, right? You know, if it stalled at the 200, 97 bucks from 84, I'll take that trade every day. You know, it's had a pretty parabolic move over the last week, so you can expect, right? Stocks don't move in straight lines. It's going to be higher highs, higher lows, higher highs, higher lows. So I kind of like it for a long. The thing to anguish over is, do I just jump in now so I don't miss, you know, a continuation, or do I wait and see if we get a higher low and then a reversal and try and catch it? And the risk to that is you miss maybe a move and then there's not enough reward left. So that, I think it's a decent long. It's an aggressive trade, but there's enough potential there. So, you know, what if it only went to the 200? That'd be a good trade. I'll take that. It's just timing your entry point that's the challenge right now. And I think there's better trades. I'm pointing out that I think it's a decent long trade. I do think there's higher probability better trades out there. Lately, we've been having way more luck in smaller cap issues than the big ones. So that's where I'm focused until things change. But it's not a bad long setup. Walmart. Well, that's not a small cap stock, is it? I got thoughts on Walmart here as well, but I'll wait my turn and we'll go. Christian, what do you think?
So I spent a lot of time on the other ones, and I apologize for doing this. So I'll be short on this one. I'm pretty neutral. It's basing below the 200-day moving average. I would just watch that 200-day moving average. This is not dividend adjusted. I think if you use a dividend adjusted chart, the 200 is around a little bit closer in the 89 handle. So I would say maybe give it a shot above the 200-day moving average. If not, for now, just an avoid.
All right. No offense to Mr. Walton. It's all about the chart. Jim, what do you think about Walmart here?
Well, I think Walmart is in a position here where if they say, from what I understand, the consumer is still pretty much out there, pretty much still spending. So, you know, I think if these 84, 85 numbers can hold up for a little bit of a while, and we started getting a little bit above 90, it's possible to go up towards this gap around 100 that it created a while back. So I would be probably looking to see if it could have some boat legs here and try to, break up above 90. And then if it did, and we're going into new highs on the S&P and all that kind of stuff, then this would be one that might participate going back into that gap area towards 100. So I'd be keep an eye on it, but this would be one that would go if the whole board goes. And so that's why the 2800 area and then the 2871 area are important up here. But if we're going to go up into those areas, I would imagine Walmart's going to be on that train.
That's a pretty good comment, Jim, and I like it, and I agree with you that I'm a technical trader. I think we all pretty much technical focused. But you got to pay attention to what's going on in the world, and I think looking for correlation between the broad market, the S&P, and Walmart makes absolute sense, right? Don't try and go long this if the rest of the market's starting to tank, right? That's just smart. Larry.
Yeah, so looking at Walmart, one thing that stands out to me, the first thing is it's one of these stocks. It's real, what I call whippy. You can see these price bars. They whip around a lot, so it's one that's hard to stay with the trend. It will trend, but you've got these really whippy moves. But if you just then zoom out on it like this, you can see that it's breaking the 618 retracement here from that prior high. And so you've got the 200-day moving average up here around 90. So this as a trade, I can see it pushing to $90. So as a trade, so that could be something that could happen into monthly expiration, which is next week, Friday. So a week from Friday. So I could see this, barring something, coming out over, the major markets, I could see this grinding towards 90.
Yeah, I actually like it for a long. If we take out this last high here, right above this high, about 87.75, it's an aggressive move. You could hit some resistance at the 200 at about 90.50. But this looks like, so here we had the big impulsive move last year. We had a textbook correction to that. And now it looks like we got pretty good evidence of a continuation of that original trend. Now I would make sure that before I went long on Walmart that we were taking out those highs and the S&P had some space to go up above it. But if those things happen, that could be a nice long. And what if it only hit the 200? Yeah, it's a win. But if it really takes off, it's got an extension target up above 113. That would be a trade worth taking. So I'm watching that one, and no rush. I'll see how things go. But I kind of like it for a long. Not at this instant, but maybe soon. BGS. We're going a little slower today, but we're getting some depth and some great content, some great comments and analysis. So I think it's all good. I don't know if I've ever looked at B&G Foods. That's interesting. Christian, what do you got here on BGS?
Come on, Dean. You've never had the Green Giant or Ortega salsa? Come on.
Hey, I see Pillsbury fired the Doughboy, right?
So yeah, I confess to I don't think I've ever traded this name before. It is I guess it's a consumer staple. I was just reading the company description. Yes, they are the Green Giant and Ortega and Grandma's and a whole bunch of other names. So I'm not that familiar with it. I would say it's above the 200-day moving average. It is above the 200-day moving average. So I would use that as a stop. I think also if you go to the weekly chart in this, which I'm doing this backwards, you should look at the weekly chart first. But it is inside the weekly value area. So as long as it holds on to 30.05, you could stay long in this name. And that's all I got for BGS.
Those Grandma's oatmeal raisin cookies are pretty darn good.
With the Ortega salsa. Woo!
Yeah, exactly. Well, Jim, this has reverted to the mean. What do you think?
Yeah, well, looking at the lows from 2017, they were about 30. So we have been able to not only get above the 200-day, but also above the lows of last year. Those are two good things. The biggest thing that's jumping out is the short interest. 33.69% of the stocks are short, and that's a lot of short interest. And that means if it got moving, these guys might start covering. And if they cover into a vacuum, you could get a nice move up, maybe even as high as 40, where the former high at the end of last year was right around that 40 mark. So this thing does look like it may have some potential. And like I say, stay above 30 and see if we can get those shorts to get scared out, and you might have something cooking right now.
I've come to really respect those short squeeze setups if the chart matches it. Those can be powerful and fast. Yeah. Larry, ENG.
Yeah,
Green Giant.
yeah, I love it when you have a major short interest, and that's a lot, 33%. So this is definitely one you don't want to be shorting, and you can see that you're, back above this 200-day moving average. So what I'd like to see is it's lost some of its momentum to the upside right here, so it's trying to pull back. So let it pull back into this kind of range here. You've got support around 30, and then see it churn, hold, and then see if you're, whatever kind of indicators you'd like to use. I like to use momentum. If I have my shorter term momentum indicators turn up, this would be one that you could look to get into.
Okay. Well, why don't we pause from the list and share what we do like? Any kind of current favorite trades, setups, charts that you're looking at that you would share with the audience. So, Christian, what do you got that you like?
Yeah, a couple names that I think are interesting. Let's see from the list. I actually like U.S. Steel here. Now, so it's going to get a little bit difficult because a lot of names are reporting earnings the next couple weeks, but I think this is a decent play in here. It's been acting pretty well. It's got so a lot of times what I like is what I call easy trades. Trades where I've got a really nice defined support area, so that as long as you're being disciplined, as long as I'm being disciplined, I can get out for relatively very small loss. Right? It's all about small losers and big winners. So I think this one's been acting pretty well, and you've got the 200-day moving average support, just sitting there. And I think it's just something a little bit different. I kind of like Boeing is another one of my plays right now that I've got on. Just something, I think tech has really made a real nice move. But we'll see what tech does into earnings. And I know Boeing has earnings too, but just looking for something a little bit away from tech just for the short while until we get some of the heavy hitters, out and reporting earnings. But X and US Steel, something a little bit different. Usually I've got a couple tech plays, but for now I want to just shy away from those a little bit.
Sure. US Steel, interesting. Jim, what do you like at the moment?
Well, I was going to say a limited risk speculation here that would be of interest to me would be a strangle position on the S&P. We hit 1193 on the VIX today, and we're hitting 2800 ballpark area on the S&P. And I think we've got a significant amount of earnings news coming up, so there could be some volatility ahead. And with the VIX hitting 1193, I would be pricing out some premiums and see if the strangles going out a little bit in time are not priced too unreasonably. And if you thought that volatility could kick in kind of in some kind of size, then maybe you could win on one side or the other to obviously make it worthwhile. And of course, no volatility at all, dead in the water, you lose on both sides. But there are times that certain strategies may make some sense. If you get to 11 and change on the VIX, if you get to 2,800 on the S&P, and you've got a bunch of earnings coming out plus GDP numbers, maybe it's not a bad time to price out a couple of strangles.
All right, that's an interesting thought. And Larry, what's on your radar screen? What do you like?
Yeah, so I've been looking since we saw that S&P right up there at 2,800 or 280. Been looking for just trades that are very, very defined risk and low risk. So for the next few days to a week, And so one that we found here today, some of the semiconductor chip makers, they've been hit pretty hard, and now they're starting to turn back up. But looking at a bunch of the different ones, the Intel has really cheap options. And so you can get really great leverage and really defined risk. So, I mean, you can keep your risk down to like 40 cents, but make, 3 to 1 on that. So I like Intel for potential push up into this area here, 54, 55. With options, we don't need much of a move to make a good return. So I like this. And then another one potentially is, been keeping an eye on the bonds, and the bonds have been holding up quite well, but I think might be worth very, very defined risk trade here on TLT, a short trade setup on TLT. You can see that TLT, the bond ETF, has pushed into this 200-day moving average. It's been trying to get back above it, but it's starting to kind of fail again. So this one, it might have another potential push back down to maybe 120, maybe even further. So it's one, again, that you can have really specific defined risk trades using options, and gives you a really great risk reward setup.
All right. It's interesting that you like the Intel trade. I worked for Intel for 14 years. So I got a lot of friends there. I keep up with what's going on in the company. Their CEO just was forced to resign a couple of weeks ago, and they're rudderless at the moment. So, big news could break on Intel, depending on how the market receives an appointment of a new chief. But it's interesting company, good company. It's too bad that Brian Krzanich had to resign, because he was the only in the last 3 CEOs who could move the stock price. I left in 10 years ago, and the stock was in a channel forever. And he's the only one that ever got it to start moving. But that's what it is. The stock I like right now is Yandex, YNDX. This is a Russian internet play. They're considered the Google of Russia. And they got a really nice pattern here on the chart. They've had a nice run up. They had a really good textbook correction down into a Fibonacci retracement zone, and now continuation of that original trend. Pretty clear evidence of that starting. We got a price target up above 48 bucks, sitting here at 37. We got long at 35, and there's still plenty of room. Current stop under the last low at 33.98. So pretty excited about Yandex. It's not it's not going to go double in the next week, but it's a good, steady, orderly chart. It is not, as my friend Larry would say, it is not whippy. It is a pretty orderly marching soldier, and I kind of like it for that reason. And I think that is, who is that doing the analysis? Is that Christian? I think that's your chart, isn't it?
Yeah, I'm looking at it. I like it.
You like it? You like it?
I like it. I like it a lot.
Oh, good. It's good to have a little confirmation from another expert
I like
trader.
it a lot.
All right. Well, no charge, man.
Yeah, I'll be looking at this one tomorrow. That's for sure. Because see, I like this. You see how tight this consolidation pattern is, and it's up the upper end, and it's crossing back above that 618. That's one of my favorite spots, and it's above the moving averages. Looks real good.
Yeah.
No guarantees.
Yeah, I like it.
It looks real good.
And I like that it's not correlated to the U.S. market. It's doing its own thing. That's good.
Really tight pattern. I love it.
Yeah, cool. All right.
Maybe Trump will buy some while he's meeting Putin later in the week.
Who knows, right? Who knows? And a country-based internet search things. It's not. I don't think it's subject to tariffs and all that noise either, right? So it's kind of nice to have something that's off on its own, right? Where were we? So IBB, I think we got time for one more, and then we're going to do our wrap up. So IBB, that is an ETF of some flavor, if I recall, biotech ETF. Yeah. So we've made some comments on biotech. I've got a few, but Christian, what do you think about IBB?
Yeah, so it definitely moved up with Biogen. So it's kind of a continuation from the one of the first charts that we had, and I like it. It's a little extended here. I'm going to use the digestion. Maybe it needs to just hold on and digest a little bit, but I like it. And it's one of these things where I think you want to zoom out. I think, and I don't have the numbers in front of me, but IBB is up around like 7 or 8% year to date. And I think a lot of people who are playing large cap biotech, which is what IBB basically is, it's market cap weighted. So I do like it here, even though it's a little bit extended to the short term as possibly a catch up trade. The reason why I say a catch up trade, because if you look at PSCH, which is the small cap, a lot of people aren't familiar with this ETF. A lot of people will also look at XBI, which I also see on the list. XBI, people say, oh, well, XBI is small cap biotech. It's actually not. It's all biotech. It's got large cap. It's equally weighted. So it's got large cap, mid cap, and small cap. PSCH is a small cap healthcare ETF. Biotech has had one of the best rallies I've seen, like under the hood. This ETF is up, I think, about 36% year to date. So if you look at that between that and IBB, which is up single digits year to date, you can kind of think of it as a reversion trade, right? That maybe the large caps, which have a number of reasons why they haven't performed as well, could be a catch up to the PSCH. But I mean, this trend in the small cap biotech and healthcare names has been absolutely unbelievable, as well as the equipment names in this space. So they've just been acting so well. And, I see a lot of people stuck on the IBB, which again, I think is good for a reversion trade at this point. For a while, it was below the 200-day moving average. So I think it can work as a reversion trade, but I still think the small caps are a better place to be if I had to pick.
You just gave a bunch of really good information. People should go back and listen to the recording and study that carefully, Christian. That's good stuff.
Thank you.
Healthcare, man, there's some good setups on like UNH and the big healthcare players, and I just can't do it. The government's withholding ACA payments, and the whole thing is just so up in the air. I'm a technical trader, but when there's something that bugs me, and I don't want to lay awake at night worrying about a trade, so I let it go, look for something else. I like biotech, but healthcare, particularly insurers, I don't like it. And I think that's a fair training point for people. Teaching point is, if something bugs you about a trade, there's thousands out there, man. Go take something different. That's where my head's at. Jim, what do you think of IBB?
Well, the 50 and the 200-day are right around the 108 area, so you got a pretty good line in the sand there. And I think the low somewhat recently is 105. So 105, 108 would be kind of the floor I'd put under this thing. And there is a gap between 112 and 114. So if it went into that area there, might not be a terrible entry point if you're bullish. And then one other positive catalyst is you got about 13, 14% short interest. So there is people that are getting blown out a little bit on this rally. But this is one of the sectors that people are kind of touting as where you'd want to be in the second half of the year. So if that's in fact going to be true, then IBB with a 105 floor and getting above 120, you could have a target of about 135, which was the highs of 2015. So that's pretty much what's going on there. So as I can see,
if they say buy it, then I better go buy it. Right?
Yeah, I'm just saying I've heard compelling stories about it, and the boomers aren't baby boomers. They're constantly getting more of them in the higher echelon of age, and they've got money, so maybe they would be able to finance all these fabulous drugs.
So, Larry, I can't wait. Is this whippy or not? It looks whippy to me, man. What do you think? Uh-oh. We still there?
Larry, I think you're muted.
All right, sorry about that. So, the healthcare stocks, a lot of them have had great moves off the bottom. So we had, had J&J. That was a good one that we jumped into. But again, the big move, the big sweet spot, the big gravy move has been made here. You can see the big gap up. But, it's holding this prior high here, so it could pull back all the way to 114, even fill that gap at 112. Then, it'd still be probably a good one to look at. But I'm a shorter duration type of trade setups that I'm looking for. So, 1 to 2 weeks. So, for me, the upside would be maybe to 120, but it could easily pull back to 114 or 105 or 112 before that. So not much I'd be doing here on that.
Yeah. You know, I mentioned when we were looking at Celgene that, you know, I use the Ichimoku Cloud and I look for a chart to see if it has respect of the indicator and you know, whether it is an orderly enough market where you can predict what's going to happen. If you look at the last year on IBB, it has smashed through support and resistance with no warning on a regular basis. It's a choppy, whippy, unruly thing, and there's better things for me to trade with my approach to the market, so I wouldn't touch it. That's my thing on IBB. Well, man, guys, we're out of time. We had a bunch of really good discussions here. So let's go ahead and.
We had a question from the audience. If you want to check or answer this quickly, Vicky asked.
You okay going over here, David?
Yeah, if you guys are okay with it.
Okay.
So she asked on stocks like JACK with $5 between strikes, do you play them or avoid them?
Yeah, it's a higher price. It's a higher priced stock, so it's not unusual for the strike prices to be spaced at $5 when they're up around 100. That's normal. I trade those all the time. I wouldn't trade Jack, but that particular point wouldn't stop me. Other comments on that?
I'm with you.
Like you were saying, the higher the stock, obviously they're not going to have the $2.50 increments. And then the only other thing to keep an eye on when you're doing option trading is try to look at what the bid offers are, how far the spread is, and of course what the open interest and the volume is, so that if you wanted to get in or out and you had any size, you'd be able to get some liquidity.
Yeah, good point, Jim, and I'm glad you pointed that out. That I'm way more concerned about the bid-ask spread than the strike spread. That's the critical.
The bid-ask is pretty wide here on Jack, so it's not one that I'd be probably. There'd be other better ones.
Yeah. Yeah, good. Well, let's go ahead and wrap it up, guys. If each of you've got a website or a link or closing comments you want to make before we wind it down here, Christian, anything you want to share? Last thoughts?
Yeah, sorry, I just had to unmute the mic there. Yeah, last thoughts. You know, this is what we do all day long, and it's, you know, it's always a pleasure to be on the panel. But I love to go through and look at charts. So, you know, I don't mind going over a little bit. But yeah, that's what we do at Tribeca Trade Group. You know, we kind of look for trade setups, and it's fun. And if you have a passion for the markets, then you go check us out at TribecaTradeGroup.com. We offer I think a 7-day trial for $7.99 or something like that. But check us out. My Twitter handle as well. I put a lot of setups out for free on Twitter is @CFromhertz. It's my first initial and last name. So again, thanks for having me, and hopefully look forward to seeing you guys in the room.
All right. Hey, good to be here with you, Christian. Jim, closing thoughts for you, sir?
Well, just thank you to everybody here, and I thought it was a great meeting, and thank you to David again. And for those who want to learn a little bit more about options or ask any questions, optionprofessor@gmail.com is the way to contact. And as always, good luck and good trading on everything that's going on out there.
All right. Thank you, Jim. And Larry Gaines.
Yeah, thanks again for having me here today. And as usual, a lot of fun. So if you'd like to check us out, Power Cycle Trading, here's our website. Just go there. Got a lot of good free ebooks, stuff that you can utilize. And if you click here where it says click here for Larry's upcoming events, we have all of our free webinars that are coming up. So you click there and see if you'd like to join us for one of our webinars. So appreciate everybody being here, and good luck trading.
All right. Hey, thanks. And enjoyed your comments, Larry. And again, I'm Dean Jenkins, founder of FollowMeTrades.com. We got a stock picking service, trading room, and some training courses. And a great way to put a toe in the water, see what I got going on, is to sign up for the free newsletter, published weekly with market analysis. Newsletter is called Beyond the Noise. All right. Well, hey, that was good fun. And thanks again to the panelists. I really enjoyed talking through these charts with you guys, hearing your opinions. And David, go ahead and send it back to you, sir.
All right. Thanks, guys. Just a reminder for everyone, be sure to subscribe to Timing Research on YouTube or wherever you listen to podcasts. Also, both shows will be off next week. The Wealth 365 conference is going on all next week, so we're taking the week off so everyone can attend those talks. Larry, I think you're doing one, right?
Yeah. So yeah, I'll be doing one. I think it's Wednesday, I believe.
Okay. Yeah, they have on the Wealth 365 site. You can go there and everyone can check out the full list of speakers for that. And I'll also have links on my site to that as well. So I encourage everyone to check that out. It's wealth365.com. And just want to thank my guests again for this week. Christian Fromhertz of TribecaTradeGroup.com, Jim Kenney of OptionProfessor.com, Larry Gaines of PowerCycleTrading.com, and Dean Jenkins of FollowMeTrades.com. Thanks, everyone.
All right. Thanks, David.
Thanks again, David.
Thanks, David.